Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. Today, I'm going to be analyzing Texas Instruments stock after its recent earnings report. If you have a request for an analysis from a stock that's in the S&P 500, just drop it in the comments section, and I will put it on my list. And if it's part of the S&P 500, I will post a free YouTube video on YouTube. And if it's not in the S&P 500, I post those over on Patreon, which is $5 a month. And then you also get a big discount to my full service, the Cyclical Investors Club over on Seeking Alpha, where I have all the spreadsheets, more articles, more portfolio style discussions and things like that. So you basically get a lot more over there. But if you're just interested in S&P 500 stocks and you're willing to wait until I have time to make a video, then just drop those in the comments. As always, this isn't individual investing advice. This is just how I personally analyze these stocks when I'm trying to figure out whether I want to buy them or not. So, Texas Instruments. I like to start by reviewing anything that I've done on the stocks in the past. So I wrote on Texas Instruments back on Halloween in 2019, so almost exactly 4 years ago. At that time, I rated it a sell, and the reasoning was basically just the valuation, and it's moderately cyclical too. So a lot of times people don't take into account that earnings cyclicality when they try to analyze these stocks. And it's really important with a stock like Texas Instruments that can go through kind of moderate earning cycles that you do that. So I usually come in a little bit lower, sometimes a lot lower than kind of a standard analysis. And that was the case with Texas Instrument stocks back in 2019. What's interesting is if you read through this article, I'll link it down. I don't know if it will be paywalled or not, but I'll link it down in the description. If you want to see what I had to say 4 years ago. But the upshot was I was projecting about 2.51% 10-year CAGR. So that would be like a long-term CAGR over 10 years based on what it had done in the past. So 4 years later, that would be about a 10% increase, right? Even though it was a sell article. When you consider that when I wrote this, we basically had no inflation and we've had about 20% inflation since then. If you take that 10% that I would have expected it to rise along with the 20% inflation, we're pretty much right in line with the total return that it's seen since then. I would expect this stock to keep falling if we have a kind of an economic downturn or even a mild recession or slowdown coming off the type of peak that we've come off. So while in absolute terms, it hasn't lost money in the past 4 years. It has underperformed the S&P 500 right now since the recent sell-off, which I think it will probably sell off more than the S&P 500 on average, given what we kind of see right now. I mean, that can change. So I think it was a pretty good valuation sell call, given I didn't know anything about COVID and stimulus and all that stuff that kind of boosted everything for a while. The actual projections were pretty much spot on once you account for the inflation that we've had. And the price I was looking to buy it, well, let's go. So I have written about it since then. I wrote about it also at the beginning of this year. And I took a little bit different view. I was neutral on it at that point because it didn't look super overvalued given everything that we had seen. And the price that I was looking to buy the stock at, which I shared in this article, was about, I did two different types of analysis. One of them based on earnings was about $106. The other one was about $97. And that was actually a dividend-based analysis. I don't usually do too many dividend-based analysis. My dividend-based analysis is actually really good, but the problem is all these dividend stocks were way overvalued. So if I they were so far away from being like a buy that people just would kind of laugh at them when I would put out, you know, what price I was looking to buy. So $97. This was in January of this year, so that's 10 months, 9 months, almost 11 months now ago. And that didn't mean that the stock had to sell off that deeply. It's just, it wasn't, I didn't think it was a good buy with a margin of safety. Or if you're looking to get a dividend stock for the long term, that would have been an attractive price. So at the time that I published that, the price was almost $170. Right now it's $141, so it's come down a little bit, but it still has a long way to go to kind of get to that $97. Spoiler alert, that $97 hasn't changed because it's based on the dividend, and the dividend trend hasn't changed even though the price and earnings have changed. So, but I will show you how I calculate that. So, via the dividend, because it's not usually how I analyze stocks. I usually do an earnings-based analysis for a stock like this. But Texas Instruments sets up really well for this type of dividend analysis because its dividends are extremely consistent, but its earnings are actually can fluctuate quite a bit. It's not a deep, I wouldn't call it a deep cyclical, but it's close. It's like moderately deep. You can tell that from the dark green area here are the earnings per share. So when they come down about, okay, we'll call it 40%, 45%. Here, and then another time, and then the big rise, and then another time, another 40%. Usually about 50% is where I draw the line for a deep cyclical compared to just like a moderately cyclical, which would be earnings fall but less than 50%. So it's kind of right in there. And the stock price definitely fluctuates a lot. So it's going to fluctuate more than earnings. It fell probably like 65 or 70% during the Great Recession off its highs. So these are big fluctuations. But if you look at the dividend, which is this white line here, you can see that it's probably like an aristocrat or something, whatever kind of labels people. I'm sure it's raised dividends for like 20 or 25 years or something. So the dividend is actually pretty stable. It's actually pretty rational. So when management is making decisions about how much to pay out in dividends, it has a history of being of not getting like overly exuberant when they have a big earnings jump like in these years, because it knows that if they have this big earnings jump, it's probably going to be a down year. So it's not like they jump the dividend way up. They just kind of gradually raise it as time goes on. And then over time, generally the earnings are keeping up with these dividend raises. So this is actually a stock, and it's a high quality business and all that stuff, right? So this is actually, and they have a decent dividend. I'm not sure what the yield is, right? 3.5%, okay? So it's not totally insubstantial. And so what it allows you to do is you can base kind of the valuation off this much steadier dividend trend, rather than trying to use these earnings, which can fluctuate a lot, right? So it does set itself up well for this. And I haven't written very many dividend articles because so many other people do that. And every time I do it, it's like a sell basically. So, and then, nobody wants to read them anyway. So that kind of explains, I think, why you can use a dividend analysis. But the best way to use, in my opinion, to use a dividend analysis, to ask yourself, how long would it take me to earn my money back? If I spend $100 on this business, and I own the business, and I just lived off the dividends, how long would it take the dividends that they pay to pay me back my $100? So how long would it take to earn $100 on $100? And that's how someone recently emailed me about, or messaged me about whether I was going to do any more of these dividend analysis because they liked them so much. But I think I haven't done one in a year, or nearly a year, and they were the first person to ask. I just figured nobody wanted to read them. But so this is how it goes. let's see, this is actually my earnings-based analysis. I'm not going to take you through the whole thing because earnings can fluctuate a lot on this, so I have to make some adjustments. If you look at the growth, including these earnings fluctuations, maybe I will talk about this for just a little bit. It's not super fast. It's like 5.64% since 2015. And the reason for that is now if you it all depends on how you measure earnings. So I count this decline. I'm not sure that growth rate completely counts this decline, but it might. I know I didn't use it for this. So these earnings come up and down, so not every year is just straight up and down. So if you just measure from this point to this point, I don't know what FastGraphs has now. So they have a 10.5% earnings growth rate, so there's a big difference. I also control for buybacks and things like that. So I think it gives a better idea of what the real earnings growth rate is. And that's important for the dividend because you want the earnings growth rate to be similar or faster than the dividend growth rate over time. Or else you won't have enough earnings to support your dividends, right? So this is my earnings growth rate. And I think I just adjusted. No, I haven't even changed it from. This is what they were expecting on earnings, by the way, the last time I looked at it, and now they're much lower. So you can see analysts have got this wrong. And I'm sure these are actually, you know what? Let's go back and look. Let's take the time machine back to January. So $6.54 is now what analysts think they'll earn this year. I'm just going to scroll down because I probably posted a fast graph here. Yep. Okay. $8.57 is what they thought 10 months ago for 2024. And they thought $1 more this year. So they did expect a decline. Now they got super negative on next year. It's completely predictable. I mean, not the exact amount, but that it would happen. So 850 something, and now we're down to 650. So it's like 25% or something difference. And that's why the stock price is falling. But it was pretty predictable. The direction was predictable. The magnitude is, you can roughly kind of understand what's going on. The exact amount, nobody really knows. But you want to know that it can happen. And a lot of people that were buying up here, they didn't really know that that could happen. They just thought, oh, it just goes in one direction and every now and then you get a little bump in the road. But no, you get these big 40%ers. If this is similar to those last two declines, this will be even worse. So that's why kind of this dividend analysis makes sense here. If you don't make all those adjustments that I made. So I'm coming out, now that things are getting more negative, the buy price is actually, this was 106 when I wrote that last article using earnings, and now it's 20% lower because the earnings have not done as well as expected. And then I made all kinds of adjustments. Maybe that's where I had that number before, because they probably, let's look and see. So yeah, they were looking at 796 and I was estimated 730, and they're actually going to come in below that 730. So let's see here. I'm getting slightly sidetracked, but not really. So the dividend is what we want to look at, which is, here we go. Okay, let me move myself down here. So the way I do this dividend analysis, and you can see the end result here, it's going to take 13 years to earn your money back via the dividend. So if you invest $100 to get $100 back from a dividend, it will take about 13 years based on the trends that we can go look at. Their dividend growth rate, the last time I updated this was probably earlier this year. It doesn't really change very much. It was about 18%. But the earnings growth rate was only, we'll call it 6%. So they're growing the dividend faster than they're growing earnings. And that's only sustainable for a certain amount of time. So what I like to do is, in this situation, if the payout ratio is over like 50%, which it is, right? I blend these two together. So it's about 12% is what they could continue to grow the dividend rate at over a certain time. We'll say 13 years. I don't know if it'll last that long. These are just estimates, right? So if we, and they're more conservative than what they have been. So if a person said, oh, they're going to grow the dividend 18% forever. Well, probably not if earnings are only growing like 6%. So I take it down more conservative. It's like 11 or 12%. You look at what the rate it is here, what the yield is, and then how much that would add up to over time with your $100. So after 5 years, you would have like $125, and then after 10, you'd have like $169. And so right at this 12 to 13 year point, this is where it's programmed to turn green, you get more than $100 back, right? So you're somewhere in between like 12. It's probably getting, if the price drops a little more, it'll probably only take 12 years to earn your money back with the dividend. My threshold for buying a stock based on the dividend like this is about under 10 years or at 10 years. So the way to calculate, I think I can do here. I'll just like type it in. Type it in. That has 10 years. Now you earn your money back in 10 years just from the dividend. It would become a buy, and that happens at about $97. So right now it's at 41. So we still have a way to go to get down there, and that's how that's calculated. It's relatively simple. It's really just some judgments in terms of what you think the earnings growth rate should be, and how much you demand, how soon to get your money back from the dividend. Now, for some context, I think when it comes to dividend investors who really just care about the dividend and income for retirement or whatever, really the best proxy is a 60-40. So, and a 60-40 right now, it'll take you 20 years to earn your money back from the dividend if the trends continue that we've had. So, on a relative basis, if you're only investing for like income, Texas Instrument looks pretty good. But on an absolute basis, for me, I don't want to wait 13 years to earn my money back from the dividend. I want it back sooner than that, which is in 10 years. And usually that will result in also good stock, as long as the business keeps doing well, that will result in good stock returns as well. If I go back to my other type of analysis, which is the recession analysis, that has almost the exact same price, right? So this is based on how much the stock fell during previous recessions relative to their peak earnings. And so we have all these things pointing to like that $97 upper 90s share price. That's probably a good spot to consider buying it. Now, when that happens, or if it happens, again, I'm not predicting it's going to fall that far. I'm saying it's not a good deal for me unless it falls that far. Although the recession PE is a predictor based on past recessions. So it does actually, so when you see everything kind of pointing around the same area, that's usually where you want to roughly aim. And so, yeah, it needs to fall farther. But when it does, when this falls even more and the market says, oh, they're only going to earn, well, let's see. Let's just say it falls the same as it has before. We'll say it falls 40% off. I'm looking at my calculator here. That would be $5.64 a share for 2024. Usually it's 2-year decline, 40% roughly decline. So when they get to where they're going to earn $5 a share and the stock's trading at $97, $95, that's when you want to buy, because eventually this cycle will turn up and there'll be more demand for, making semiconductors and the other equipment and stuff they make their things for. So that's the way to kind of think about it. Now, maybe the market maybe it doesn't happen, it doesn't fall that far. That's okay. All the people that have bought, who were impatient, who've bought since in the past 2 years are underwater now. So yeah, if you just wait out until you get a good deal, then you don't have to have 2 years of wasted time with no return from your investment. Cash at least would have paid you 5% or something over this time, maybe 6%. So yeah, that's my Texas Instruments analysis. A little different than my other analysis. If you want to see more detail on the earnings based stuff, you can watch my other videos if you want to see the process behind that. But I thought this one was interesting because of the dividend. If you like this analysis, you want more dividend analysis, if you want to specify when you ask for what type of analysis, you can do that in the comment section too. I can do this dividend thing on any kind of popular steady dividend payer, or I'll tell you why I don't think it's a steady dividend payer. And yeah, hit the subscribe button and do all that. Check out the full service if you want some more some smaller businesses covered. Patreon's a good way to do that. And I'll see everybody later. Bye.